Hello, my fellow stock buddy. Welcome to my humble channel where we try and make money. And honestly, let's try to be a perma-China bull here because the Chinese and Hong Kong market is just super depressed right now, with major tech companies trading at a PE of less than 15. So let's see if we can make some money here. The Chinese market is absolutely wild right now. Alibaba has experienced a brutal sell-off over the last 12 months, watching its stock tumble from a high of $160 down to a measly $92. That drop represents a massive destruction of market value for one of the most prominent tech giants in the world. Yet this decline has also pushed the firm's price-to-earnings ratio down to a mere 15. This valuation means investors are paying just $15 for every single dollar of profit the company makes, which is incredibly cheap for a tech firm of this scale. In comparison, US tech giants regularly trade at multiples of 30, 40, or even higher. It seems the market is pricing Alibaba as if its business is going to disappear entirely. We need to look closely at the data to understand if this is actually a rare buying opportunity or a dangerous value trap. To understand why this stock has been dropping for a year, we have to look at the massive headwinds hitting the company right now. Just this week, Alibaba and its US payment subsidiary agreed to pay a $600 million settlement to resolve a federal investigation. This inquiry focused on allegations that the platform failed to prevent the illegal importation of pharmaceuticals, controlled substances, and pill-making equipment into the United States. It is a massive compliance headache that raises serious questions about their global marketplace standards. But the regulatory trouble does not stop there. In late June this year, the popular American artificial intelligence company Anthropic accused Alibaba of obtaining illicit access to their Claude model. Anthropic claims that the Chinese e-commerce giant created fake accounts to scrape and extract their core model capabilities. This allegation immediately triggered a series of class action shareholder investigations from top investor rights law firms. These firms are now digging into whether Alibaba made misleading statements to the public about its technology practices. At the same time, we saw domestic regulators step in to cool down the intense competition. Just ahead of the massive June 18th shopping festival, Beijing regulators summoned Alibaba and other major platforms over what they called destructive promotional practices. The government is actively trying to end the brutal price wars that have been crushing profit margins across the entire sector. To make matters worse, Goldman Sachs just removed Alibaba from its prestigious Asia-Pacific conviction list. This removal reflects a major shift in institutional confidence as analysts reassess the near-term growth of the Chinese consumer sector. When you combine regulatory fines, AI intellectual property disputes, and flagging consumer confidence, it becomes obvious why Wall Street is running away. Quick pause, everyone. If you haven't noticed, I'm using a digital clone of myself here. I am on a personal quest to prove that digital avatars do not have to be cheap AI slop videos. I will always research and write every single script myself to bring you the highest quality, most informational stock analysis content on the web. To understand if Alibaba is a buy, we have to look at what this business actually does and how it makes its money. Alibaba is not just a single online store, but a massive, highly integrated ecosystem that dominates almost every layer of commerce in China. At its core are Taobao and Tmall, which are the primary engines of the domestic e-commerce business. Unlike Amazon, which buys inventory and resells it, Alibaba acts as a pure marketplace. They do not hold inventory for these core platforms, which allows them to run a highly profitable model with incredibly strong margins. Instead, they make their money through customer management revenue, which basically means charging merchants for search advertising, digital storefront setups, and transaction commissions. This marketplace model is supported by Cainiao, their logistics arm that handles millions of packages every single day. Cainiao does not just deliver goods, it coordinates a massive network of independent couriers, giving Alibaba unprecedented scale and cost efficiencies. Then we have the international division, which includes AliExpress, Lazada in Southeast Asia, and Trendyol in Turkey. This international segment has been growing rapidly as the company attempts to capture global markets outside of China. But the crown jewel of Alibaba's future is their cloud intelligence group. This unit is the leading cloud provider in China, and they are currently expanding their footprint in artificial intelligence. Just recently, under Chief Executive Officer Eddie Wu, they restructured their entire AI operation into the Alibaba Token Hub. This move unites their Tongyi laboratory, their Qwen large language models, and their model-as-a-service platforms under one single roof. They are seeing incredible traction here, with AI-related product revenue growing at triple-digit rates for 11 consecutive quarters. They even released Qwen 3.7 Max, an advanced model designed for complex coding and agentic reasoning that rivals the best Western AI systems. So, the business is essentially an e-commerce juggernaut attached to a high-growth cloud and AI leader supported by a world-class logistics network. Despite this massive ecosystem, Alibaba is locked in a brutal multi-front war. In core domestic e-commerce, their biggest threat is Pinduoduo, which has eaten a substantial portion of Alibaba's market share. Pinduoduo achieved this by focusing on ultra-low-cost products and a highly viral group buying model. This forced Alibaba to respond by investing heavily in their own quick commerce and discount platforms, which has temporarily dragged down their margins. Additionally, Douyin, the Chinese version of TikTok, has transformed into a massive live stream shopping powerhouse, pulling millions of younger shoppers away from traditional search-based apps. This means Alibaba has had to spend significantly to defend its territory, resulting in a 74% drop in operating income in recent quarters. But Alibaba still possesses a highly powerful weapon, which is their interlocking moat of scale economies. Their logistics network, Cainiao, is so deeply integrated with their marketplaces that it creates a massive barrier to entry for smaller competitors. It is incredibly difficult for any newcomer to replicate the sheer speed and low shipping costs that Alibaba offers. In the cloud space, they are also facing stiff competition from Tencent and Huawei, but Alibaba retains a dominant first-mover advantage. Their annualized AI revenue run rate has already surpassed 35 billion yuan, proving that they are successfully translating their technical expertise into real corporate spending. The strategy is to use the massive cash flow from e-commerce to subsidize their expensive AI and cloud infrastructure investments. This keeps their competitors at bay while they secure the future of the cloud market. It is a classic scale game where only the largest players with the deepest pockets can survive the transition to the AI age. Now let's focus on the valuation, because this is where the thesis gets really interesting. As we mentioned, Alibaba is trading at a price-to-earnings ratio of just 15. For context, a price-to-earnings ratio of 15 means that if Alibaba's earnings remain completely flat forever, it would take exactly 15 years for the company to generate enough profit to equal its entire purchase price. This is an incredibly low bar for a company that is still growing its revenue. It tells us that the market has priced in a highly pessimistic scenario, essentially expecting zero growth or even a steady decline in profitability. But let's run some actual numbers to see what happens if they manage even modest growth. If Alibaba can grow its earnings by a moderate 15% annually over the next 3 years, its cumulative earnings will increase by approximately 52%. If the stock price stays at $92, this growth will push its price-to-earnings ratio down to just under 10. A price-to-earnings multiple of 10 is what you typically see for struggling legacy industries with no future, not a dominant technology giant. And we also have to look at the massive pile of cash on their balance sheet. Alibaba is currently holding approximately $59 billion in net cash, excluding their long-term debt. When you subtract $59 billion from their total market cap of around $235 billion, their enterprise value drops to just $176 billion. This means that nearly a quarter of the company's entire market value is backed by cold, hard cash. This cash cushion gives management immense flexibility to weather any economic storm. They are using this cash to aggressively buy back their own shares, which naturally increases earnings per share and provides a solid floor for the stock. This level of safety is incredibly rare in the tech sector, making the current valuation highly compelling for patient investors. However, we must look at the risks because a cheap valuation alone does not guarantee a successful investment. The primary risk is the ongoing geopolitical tension between the United States and China. Alibaba relies heavily on global markets and cross-border trade, meaning any escalation in tariffs or export restrictions could severely harm their business. For instance, the United States has placed strict limitations on the export of top-of-the-line microchips to China. This makes it incredibly difficult for Alibaba's cloud intelligence group to access the advanced graphics processing units needed to train their large language models at the same speed as their Western rivals. This chip bottleneck could put them at a severe disadvantage in the global AI race, regardless of how much capital they invest. Another major concern is domestic regulation within China. While the government has shifted its stance to support economic growth, they still maintain a highly watchful eye on major tech platforms. The recent regulatory summons over competitive pricing practices proves that the days of unchecked growth are over. Finally, we must consider the execution risk of their current strategy. Alibaba is spending billions of dollars on AI infrastructure and logistics expansion. This aggressive capital expenditure is directly dragging down their short-term profits and free cash flow. If these heavy investments fail to deliver strong returns over the next few years, shareholders will face continuing dilution of value. So, while the stock is cheap, it comes with real structural risks that investors cannot ignore. In summary, Alibaba presents a highly classic trade-off between a dirt-cheap valuation and serious structural risks. On one hand, you have a massive market leader, trading at a price-to-earnings ratio of just 15, backed by nearly $60 billion of net cash and a dominant position in Chinese e-commerce and cloud computing. On the other hand, you have constant regulatory pressure, severe microchip restrictions, and fierce domestic competition. This is purely my opinion and my personal journey, so you should always do your own research first. If you found this deep dive helpful, please subscribe to the channel for more detailed stock analysis. Thank you so much for watching, and I will see you in the next video.